Okay, so now we're picking up with the rest of chapter 21, and we're talking here about, we're going to take a little example of a company, Playtime Park, and we're going to use them in a couple different scenarios here. So Playtime sells their tickets for $60 a person, their variable costs are $24, and their fixed costs are $226,800 per month. So the first thing it asks us to do is calculate the contribution margin per unit and the number of tickets they have to sell to break even, and then it asks you to perform a proof to show your answers correct. So I'll show you what we mean with that one. So the unit contribution margin is selling price minus variable cost. So in this case, that is 60 is the selling price. The variable costs are 24. So their unit contribution is $36 per ticket. So that means their break even in terms of number of tickets is the fixed costs over the unit contribution margin. Their fixed costs are $226,800. Their unit contribution is $36 a ticket. So that means they have to sell 6,300 tickets in order to break even. Now, when they say a numerical proof, what that really means is we'll just put that into sales minus variable cost minus fixed costs equals their profit or their operating income. And so let's plug 6,300 tickets in. So the sales revenue would be 6,300 tickets times $60. The variable cost would be 6,300 tickets times $24 each. And their fixed costs are $226,800. And we will see if we come out with a profit of 0, which would mean we'd be breaking even. So this is 378,000. The variable cost, the total variable cost would be 151,200. The fixed costs are 226,800, and so sure enough that comes out to 0. So if they sell 6,300 tickets, they will have no profit or no loss, and they will be breaking even. The next one here says, let's see, okay, so we have the same initial information, and we want to calculate the contribution margin ratio and use this to determine the sales dollars they need to break even. So the contribution margin ratio is the unit contribution margin over the selling price. So that would be the 60 minus 24, the selling price minus the variable cost, over the selling price of 60. So 36, which is the unit contribution margin we got in the last problem, divided by 60 gives them a contribution margin ratio of 60%. Then break-even sales dollars, the amount of sales they have to break even, is the fixed cost over the the contribution margin ratio. So we take the 226,800 in fixed costs divided by 60%, and we get 378,000. You could also, now they asked you to use the contribution margin ratio approach in this one, which is what we've done, but you could also say the break even that you got in the last one in terms of number of tickets was fixed costs over the unit contribution, 226,800, divided by that contribution of 36, and we got 6,300 tickets to break even. Each one of those sells for $60. That's the selling price, and so that's $378, which, if you look back, is what we got right here for the sales at break even. So we know we got the right number here because we've seen that one before. If they don't tell you which way you have to use, you could have gone either way to get the 375, either the break even in terms of tickets times the selling price, or the fixed cost divided by the contribution margin ratio. Okay, now we're going to do a little sensitivity analysis. We're going to start with the same initial information, and we're going to say what happens if something changes. So in the first one, it says that they dropped the ticket price from 60 to 54 and needed to increase the number of tickets sold. So the unit contribution margin now will be 54 minus the variable costs are still 24. So the unit contribution is now 30. So the break even in terms of number of tickets will be 226.8 divided by 30. So I get 7,560 tickets. If I want that in terms of sales dollars, I take that times $54, which is the selling price per ticket, and I get, I hope I can fit this on here. Oops, I thought I was going to do that. Oops, sorry. 408,240 is the, sorry, I can't get that other equal sign in there. So that's my sales dollars. The second part says, all right, ignore everything in number 1, and instead of changing the price this time, we're going to change the variable cost up to $30 a ticket. And they want you to calculate the new break-even point in tickets and sales dollars. So the unit contribution will be the selling price of 60 minus 30 is now the variable cost. So my unit contribution is 30, which is what it was in the last one, right? So I should come out with the fixed cost of 226.80 or 800 divided by a unit contribution of 30. I get 75.60 in tickets. Again, but now each one of those is selling for $60, so the break even in terms of sales dollars is $453,600. That's how I would approach this problem. For some reason, in the demo problem, if you're working on the demo problem in my lab, they approach the first one, they do the tickets times the selling price. The second one, they use contribution margin ratio approach. I'm not really sure why they would switch in the middle of a problem, but we can do it that way. So contribution margin ratio is the unit contribution margin over the selling price. So in this case, that's going to be 30 over 60, or 50%. So the break even in terms of sales dollars is fixed costs over CMR, contribution margin ratio. So I'd take the 226,800 divided by 0.5, and I get 453,600. Then to get, that's dollars, to get the number of tickets, I would divide that by the price per ticket, and I get, I get 75.60 tickets. So either way, you get to the same answer, and either way is fine. I'm not really sure why they switched in the middle of it, but okay. The next one, we're going to take that same information, and now instead of changing the selling price of the variable cost, we are going to change the fixed costs. So they found a way to reduce their fixed cost to $208 per month. Let me go back to this one a second. In each of these, before before any changes, my unit contribution was 36, and my break even in tickets was 6,300. So you can see whether the revenue per ticket, whether the selling price goes down or whether the variable cost goes up, each ticket is contributing less to the fixed costs. And that's why the break-even point is going up in both of these. I have to sell more tickets before I start turning a profit. I have to sell more tickets to cover my fixed costs because each ticket is contributing a little bit less to that. So that's exactly what we would expect to see here. In this one, I can see that my fixed costs are going down. So if my contribution stays the same and my fixed costs are going down, my break-even should go down. I should cover my fixed costs and start earning a profit sooner. So I need fewer tickets to break even is what I should see with this one. So the unit contribution margin is going to be, again, selling price minus variable cost. So we're back to our selling price of 60, our variable cost of 24, so I'm back to that $36 per ticket unit contribution margin. So my break even will be fixed cost over unit contribution margin. So my new fixed costs are 208,800 divided by the 36. So now I have to sell 5,800 tickets to break even. So that's down from my original 63, which is what I would expect. If they want that in sales dollars, I can take that times $60 selling price per ticket, and that gives me $348. in sales dollars, which is also lower than my original one was. There's another way we can do this. This is probably the logical way, but here's the other way we can do it. Our old fixed costs were 226,800. My new fixed costs are 208,800. So I have a decrease in fixed costs of 18,000. If I divide that by the change in my fixed cost, and you can do this whether you're talking about an increase or a decrease in fixed costs. So if my fixed costs go down by 18,000, I divide that by my unit contribution. That gives me 500. So that means I have to sell 500 fewer tickets to break even. So my old break even was 6,300 tickets. I'm decreasing that by 500. So that means my new break even in terms of tickets is 5,800, which is what we got right here. So you can calculate the new total, or you can do the change. And you could do that if you were looking at buying something that increased your fixed costs by whatever. And so you would say, how many more tickets do I have to sell in order for this to pay for itself? Or an ad campaign that was $20,000. How many new tickets would that have to bring in to make it worth paying for itself? And so let's say you did this and you were increasing fixed costs by 18,000. You would have to sell 500 more tickets in that case in order for this marketing campaign to pay for itself. And then you can decide whether you think that's feasible or not. So that's another way to use break-even as a little shortcut for decision making. Okay, margin of safety is the last one we have for playtime, I think. There's one more. And this isn't too hard. So margin of safety is just the difference between what you expect to sell and your break even. So in this example, it says they expect to sell 700 tickets. And if we're referring back to the original information, we know our break even is 6,300 tickets. So our margin of safety is 700 tickets. That's how far above break even we are. And if they want that in dollars, each ticket sells for $60. So that gives me $4,200 or $42,000 in sales is my margin of safety. If you wanted to shortcut to their profit, 700 tickets, 700 tickets above break even times the unit contribution. So 700 tickets above break even. The first 6,300 tickets are covering your fixed cost. After that, they're contributing to profit. So if you take that times the 36, which is the unit contribution margin, that gives you your profit or your operating income. And I don't have a calculator handy to figure out what that is. So whatever that is, that's what their profit. That's a shortcut to get their profit. Sorry about that. And the last one with them is operating leverage. So operating leverage is it kind of the more, I think we talked about this in an earlier chapter. It's this is kind of giving us the relationship between their fixed and their variable costs, and we can use this to estimate. So if we take their operating income, the contribution divided by operating income, that will give us their operating. Income. That gives us their operating leverage. And that tells us how much of an impact an increase or decrease in sales will have. So whether it's, so if you have a high operating leverage, a small increase in sales is going to give you a big increase in profit, but a small decrease in sales would also have a big cut in your profit. So it kind of, how much that increase or decrease is kind of amplified. So for their profit, oh, there we go. That's what I had. It's 25 too. I knew I had that figured out somewhere. 25, 2. 25,200. So that's our shortcut here. The first thing we need is their operating income. And you could figure out total sales revenue at 7,000 tickets and total variable costs at 7,000 tickets. Or you could say break even is 6,300 tickets and their expected sales are 7,000 tickets. So they are 700 tickets above break even. So that means each one of those 700 tickets, fixed costs are already covered, so those guys are contributing straight towards your operating income. So that gives us $25,200 operating income. And again, if you wanted to check that, you could take 7,000 tickets times $60. Oh, sorry. Yeah, $60 for the sales revenue minus 7,000 tickets times $24 for the variable costs minus 226.8 for the fixed costs, and you get 25,200. So two different ways to get to the same number. Now that I have that, I can say, okay, my operating leverage is my total contribution divided by operating income. Now my total contribution will be $36 a ticket times 7,000 tickets, which equals 252,000 divided by my operating income of 25.2, and I get a nice round even 10 as my operating leverage. Now, that's what the first part of this asks us. Then it says estimate the degree of operating, or estimate the operating income if sales increase by 15. So rather than redoing the entire income statement and doing 15% higher sales, 15% higher on your variable cost, we can use this. And so we can say their income now, their operating income now is 25.2 times a 15% increase in sales times the operating leverage, which is 10, will give us the change in operating income. So 25.2 times 0.15 times 10 gives me 37,800. So my old operating income was 25.2. This tells me the increase. So an increase, if this was a decrease here, this would be a decrease over here. Plus my increase means my new operating income is 63,000. So you can see that a 15% increase in sales increases their profit by more than 15% because of this operating leverage. And that will change based on whether this company has a lot of fixed costs or a lot of variable costs. But the same thing, a 15% decrease in sales would get amplified by this operating leverage as well. And so then they would really be in trouble. Okay, the last thing in this chapter is weighted average contribution. And so this is when a company sells more than one product and the products have different contributions. And since they make up different, we do what's called a weighted average based on the percent of the sales mix that this product works. So in this case, as an example here, Soak and Fun Swim Park sells individual and family tickets. With a ticket, each person receives a meal, 3 beverages, and unlimited use of the swimming pools. They have the following ticket information and variable cost. So we have different contributions, right? So the unit contribution margin for each of these will be the sales minus the variable cost. So for individual tickets, the unit contribution is 15, and for the family tickets, it's 20. But we can't just average them together because they expect to sell one individual ticket for every 4 family tickets. So they're selling a lot more family tickets, which changes everything. And their fixed costs are $76,000. So the first thing we're going to do is the weighted average contribution. So this is how they do it. Individual, family, and total. So the unit contribution margin, we just said for individuals was 15, and for families it's 20. We take that times the sales mix, all right? So we sell one individual ticket for every 4 family tickets. So if I do it like this, I get, and there are different ways to do it, but this is how they do it in your book. I get 15 there, and I get 80 there. So I have 5 parts, and the total here is 95. So I'm just adding across this way, all right? 1 plus 4 equals 5. And I get a total contribution of them together of 95. So the weighted average, I just take the 95 divided by 5, and I get $19 is my weighted average contribution margin. And you can see it's closer to the 20 than the 15 because the family sales make up 4 times as much as the individual. And so I would expect it to be closer to the 20 because that's a lot more of my sales. And so that's how the weighted average contribution works. From then it works mostly the same as what we did before. So break even in terms of number of tickets is fixed cost over the unit contribution, and I'm going to use this weighted average one. So the fixed costs are $76,000 divided by 19 means I have to sell 4,000 tickets to break even. However, it has to follow this same sales mix. So it has to be 1/5 has to be 1 out of 5, has to be individual, and 4/5 has to be family, 4 out of 5. So that means I have to sell 800 individual tickets and 3,200 family tickets to break even. If I sell 4,000 tickets, but it's not this mix, it won't be exactly break even. Because this 19 is only relevant at this 1/5, 4/5 ratio of sales mix. So let's do one more problem with this just so you can kind of see this one. And here we have the same thing, except we're selling, I thought I changed that. Oh, I think I copied the wrong thing. Oh, yeah, here it is. They sell 4 individual tickets for every 1 family. So the sales mix has changed, or the sales mix has changed. So my individuals have a unit contribution of 15, and my family has a contribution of 20. It has a higher contribution. Because the sales mix has changed, I'm now selling more individual tickets. My average should go down. It should be much closer to the 15 than the 20 now. And so that's a lower contribution. My break-even should go up. I have to sell more tickets to get to the same point. So let's see if that's what we get. Individual, family, total. So the unit contribution of individual was 15, and family is 20 taken from here. And now this is 4/5 of my volume, and this is 1/5. You could do it that way too. You could take this times 4/5 and this times 1/5 and add them together, but I'll just keep doing it the way the book shows you. So this is our sales mix. So now this becomes 60 and this becomes 20, and so the total is 80, and so now the weighted average unit contribution is 80 divided by 5, or 16 per ticket. So the break even, and so you can see that's lower, and that's much closer to the individual since that's now a bigger part of my sales mix. So the fixed costs are $76,000 divided by 16 makes it 4,750 tickets. I had 4,000 before. Now I have to sell 750 more tickets to get to the same point, because the item with the smaller contribution is contributing more. But again, that has to be 4/5 individual and 1/5 family. So that comes out to 3,800 individual tickets and 950 family tickets in order to break even. So there's some weighted average ones, and I think that is it for Chapter 21. Let me know if you have any questions.